This week has been insane. So what happened and how are you going to make money off of it? Now here on the channel, I cover a very wide range of topics, from financial markets and education to strategies and the latest fintech innovations before they hit the mainstream. If you're interested in staying ahead of the curve and joining a community of like-minded individuals, don't forget to hit that subscribe button and become part of our growing family. This week was full of surprises. So what happened? This week proved to be nothing short of astonishing as we witnessed a series of unexpected events unfold. In the United States, three prominent banks, namely Silicon Valley Bank, Signature Bank, and Silvergate Bank, expected a downturn all within a mere span of 7 days. Let's dive into the details of what exactly happened for the two largest players, Silicon Valley Bank and Signature Bank, to provide a clearer understanding of the situation so you can make some money. When you deposit money into a bank, the bank puts that money to work by investing in bonds and extending loans to fuel economic growth. Although the initial purchase price of bonds may be high, they often provide a reliable return over time as they mature, making them a very attractive investment. In the past decade, with the central bank's expansionary monetary policy, many banks have increased their holdings of bonds to generate stable income in an environment of low interest rates. However, as interest rates began to rise rapidly due to the Fed and governments claiming inflation was transitory, bond prices experienced a very sharp decline. When interest rates increase, the value of existing bonds tend to fall because newly issued bonds offer higher yields, making older bonds with lower yields less attractive to investors. This led to a significant drop in the value of bonds held by banks, impacting their balance sheets and potentially affecting their ability to generate income from these investments. Now, in the case of bonds, when interest rates rise and bond prices fall, banks holding these bonds may experience what's called unrealized losses. This means the value of the bonds on their balance sheets have decreased, but the banks haven't actually sold the bonds and realized the actual loss. It's very important to note that unrealized losses are not the same as realized losses. An unrealized loss is a reflection of the current market value and may change if the bond prices recover. However, if a bank decides to sell the bonds at a lower price than what they were purchased for, the loss becomes realized and is recorded as a reduction in the bank's income. Until the bonds are sold, the unrealized losses are simply an accounting measure that reflects the potential impact on the bank's financial position. Now here's where things get scary. In the event of a bank run where a large number of customers withdraw their deposits simultaneously, a bank may face liquidity issues if it doesn't have enough cash on hand to meet the demand. To raise the necessary cash, the bank may be forced to sell its assets, including bonds, at a significant discount. During a bank run, the pressure to sell assets quickly can result in the bank accepting prices that are much lower than the current market value of the bonds, leading to realized losses on the sale. Selling the bonds for pennies on the dollar can exacerbate the bank's financial difficulties, as the losses from the sale can reduce the bank's capital and further erode confidence in the bank's stability. This scenario leads to a devastating negative feedback loop where the bank's financial position weakens, leading to more customers withdrawing their deposits and the bank being forced to sell more and more assets at a loss to meet the demand for cash. In extreme cases, a bank run and forced sale of assets at a significant discount can lead to the bank's insolvency and potential failure. This forced the FDIC to come in and take the banks by force in order to save the depositors. Fortunately, the Federal Reserve has established a new bank term funding program to provide additional funding to eligible depository institutions, ensuring that banks have the capacity to meet the needs of all depositors without having to sell those bonds off for massive losses. Now, this caused a huge problem. This program to provide additional funding to banks has resulted in a whopping increased supply of money into the economy. In just the last 3 days, banks have drawn $165 billion from the Federal Reserve, setting a new record. This increase in supply of money will lead to heightened demand for goods and services, pushing prices higher and causing inflation to get worse. As a result of this, the Federal Reserve Chair Jerome Powell faces a difficult decision now: to prioritize combating inflation or supporting the stability of the banks. If the focus is shifted towards stabilizing the banks, it can help ensure the banking system remains functional, but it also results in higher costs for consumers due to inflationary pressures. On the other hand, if the Federal Reserve continues to raise interest rates to fight inflation, it will help bring prices down, but it could also create further challenges for the banking sector, potentially leading to additional bank closures. This delicate balancing act underscores how bad the Fed has been governing this situation and the government as a whole governing their own monetary policy up to this point. So which way is this going to move the markets? Let's explore some potential outcomes. For major market indices and assets like the Dow Jones, S&P 500, NASDAQ, Bitcoin, and Ethereum, The Federal Reserve's decision to support the banks could lead to a surge in asset prices like we've never seen before. This will also result in a weaker dollar as other central banks, such as the European Central Bank, continue to prioritize fighting inflation instead of protecting the banks. And a weaker dollar is better if you want the markets to go up. You can already see the market pricing in a focus more on protecting the banks and inflation going higher. On the other hand, if the Federal Reserve chooses to prioritize combating inflation and puts the stability of banks on the back burner, the market may experience significant declines. This is because investors will be closely watching the potential impact of the Fed's recent injection of over $165 billion into the banking system and further measures that may need to be implemented on inflationary pressures. Uncertainty about the extent of inflation's potential rise could lead to a heightened volatility and new lows in the markets in the coming months. This is because since inflation should go up from all this new capital, Jerome Powell is going to have to raise rates even higher than he would have had to do originally in order to get that inflation to come all the way back down. So what do you think? Should he allow inflation to go higher and protect the banks, or should he risk the financial stability of the banks to make sure inflation continues to go lower? There's no correct answer, guys. Let me know what you guys think, and if you guys want to see another video about learning how to trade or investing, I recommend you guys watch this one right here. Thanks.